Unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000 and you live in that house for a while. But then something happens in the housing market. The price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have a gain. So that's how we can think about these various issues. These losses don't become realized unless, like some recent companies in the news, you are forced to sell for whatever reason.